It's Friday, 21st of June, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, US stocks, what's been driving the S&P 500, and is it sustainable? Plus, what to expect from the Indian economy in Narendra Modi's third term. But first, Neil Shearing is back to talk through the big issues in global macro and markets. Hi there, Neil.
Hi, David.
Coming off the Bank of England's June meeting, that was on Thursday, we're talking Friday morning London time. Tell us what happened. Tell us whether we're on for a rate cut anytime soon.
Yes, a dovish message, really, I think, from the Bank of England for a couple of reasons. One is that the same number of MPC members, too, voted for rate cuts in June as they did in May. For the other 7 on the MPC, the minutes suggested that the decision was, quote, finally balanced. Another reason why it was relatively dovish is that for those members that judged it was finally balanced, they seem to be suggesting that the recent strength of services inflation was down to temporary transitory factors, particularly the minimum wage increase in April. There was some mention too in the minutes that MPC members might have a reassessment of the risks to inflation persistence as part of the August forecasting round, when of course we'll get a new set of projections from the bank. So potentially laying the groundwork for a rate cut in August, which has been our view for a while, that we thought that an August rate cut was on the table. And reflecting that, we've seen a bit of a rally in the bond market, particularly at the short end of the curve. And it's now about 50-50. The market's pricing a 50-50 chance of a rate cut in August. So slightly dovish from the Bank of England.
So UK June CPI on 17th of July, labour market data on 18th of July will be key for determining what the Bank of England does in August. What about the US? The big release in the coming week is PCE inflation on Friday. What are we expecting? How will it sway the Fed, if at all?
Yes, and of course the context here is that we've had slightly better news from the CPI data, Consumer Price Index data, over the past month, and the PPI data, Producer Price Index data, is the input prices over the past month too. What is the PCE numbers, the PCE inflation data that the Fed puts far more weight on, and in particular it's going to be looking at core PCE. So lots of different measures of inflation here, but our sense is that, take a step back, they're all going to be pointing in the same direction, which is to say that inflation pressures moderated in May. So we had those strong numbers at the start of the year on the inflation front. I think we're going to see those start to moderate, as I say, in May. We're penciling in a 0.1% month-on-month increase in core PCE in the May numbers, which if that was repeated in June and potentially in July, then I think that would still leave a rate cut by the Fed on the table for September.
Okay, let's step away from the data for a second, because certainly as far as Western Europe is concerned, the biggest near-term issues are elections in France and the UK. We've already seen a good deal of risk priced into French bonds in the wake of Emmanuel Macron's decision to call a snap election. We've been telling clients that there could be much more risk coming if the outcome is a messy or unappealing one. But what about the UK? Because assuming the polls are right, we're going to have a Labour government in a couple of weeks. That would also mean Rachel Reeves becomes the UK's first female Chancellor. Now, this Labour Party is a far cry from the far-left lineup that ran in 2019, and Reeves has been going around trying to convince business and the markets that this government is going to be fiscally disciplined. But doing so implies pretty tough constraints, doesn't it? On an already weak economy, something's got to give, right?
Well, right. It's night and day compared to the Labour Party that ran for office in 2019 and, of course, was beaten thoroughly in the polls. This opposition Labour Party is drawing far more heavily, I think, from the 1990s playbook followed by Tony Blair and Gordon Brown, which is to say fiscally orthodox, relentless focus on economic stability and economic management. And that's been front and centre, really, of the campaign. Now, to that end, Rachel Reeves, as a shadow chancellor, has committed to retaining the current set of fiscal rules, which themselves, I think, are a bit of a mess. They actually require the government to have its main measure of debt as a share of GDP falling between the fourth and fifth year of a forecast. I mean, it's a pretty badly designed rule, I have to say. But nonetheless, in the spirit of continuity and stability, they've pledged to keep this rule and to continue to meet it. The issue that the incoming government's going to have, I think, and it will be a change of government as the polls are suggesting, is that in order to meet this rule, that the current government has penciled in pretty substantial cuts to unprotected areas of spending, starting in 2025. And those real-term spending cuts are equivalent to about 3/4 of the real-term cuts that the UK had in the austerity years of 2010 to 2015. So pretty big spending squeeze envisaged in the current plan. So if the Labour Party commits to that, there's a question about how politically viable it is. I think there's also a question, by the way, as to whether it's even desirable, because I think there's probably scope to borrow for the government to borrow more so long as it's for investments. Nonetheless, my sense is what's going to happen here is that the new government's going to come in, the Labour Party is going to borrow from the late 90s playbook. Don't rock the boat for the first 12, 18 months or so. If it's a big majority, they'll be thinking of a two-term government at least. So don't rock the boat for the first couple of years. Try and go for non-fiscal measures of growth, such as planning reform and so on, to get the economy growing. And it's only then that they might start to think about big steps on fiscal policy, maybe 12, 18 months, 2 years in, if they can't get the economy going through other means.
Is there a danger here, though, that too much orthodoxy is not necessarily a good thing, and that these fiscal rules, as you suggest, just aren't fit for purpose? We've had Andy Haldane this week, former BOE economist, Robert Skidelsky, the Keynes biographer. Everyone at Capital Economics seems to have that biography on their bookshelf. They've all been suggesting that this fiscal framework should at least be overhauled, if not rewritten entirely. Do you think that the bond market would be sympathetic to that, or do you think it is prudent to wait 18 months, a couple of years to try and boost the economy through other means?
Well, whether or not the bond market would be sympathetic to it, I'm sympathetic to it. As I say, I think that this current fiscal rule doesn't make a great deal of sense. It's arbitrary, having debt falling between the fourth and the fifth year. So in other words, you could get a big rise in government debt in years 1, 2, 3 and 4, but as long as it falls between years 4 and 5, then that's fine. You meet your rule. I mean, that's clearly a nonsense. So I think there's enormous scope for improving the rules. I think the challenge for any incoming government would be that these rules have been changed several times already in the past few years. And of course, every government is scarred slightly by the Liz Truss effect. So if you're an incoming Labour government, which itself is scarred by economic mismanagement in the 1970s, believe it or not, so still very much a sense that they need to kind of impress upon the electorate their credentials when it comes to managing the economy sensibly. If you're an incoming Labour government, I think this is just an area you probably don't go in the first 12 months. The last thing they want to be doing is trying to campaign as being economically responsible, enter government, and then tear up the fiscal rules on day one and reset tax and spending plans. So my sense is, for political reasons, if not economic reasons, continuity will be the name of the game. But if you were starting with a blank sheet of paper, you would not have this fiscal rule. It's pretty clear to me.
What about the US example? I know that, as you said, PC inflation, big release for the coming week, but the political event has to be the presidential debate on Thursday night, Biden versus Trump. I'd be surprised if they got too far into the weeds on the US fiscal outlook, though I know our colleagues would love it if they did. But, I mean, how much should fiscal risk figure into thinking about the US outlook for the coming years? Neither candidate's shown much appetite for reining in spending. And just for context, I'm asking this because it's come via a client who put in a question in the Q&A function on CE Advance, all about the Congressional Budget Office's new forecast that the US budget deficit is going to be $400 billion higher this year at $1.9 trillion.
Yes, and I think those CBO projections may even be an underestimate in the very short term, because they assume that the 2017 tax cuts put through by Donald Trump, which are due to expire in 2025, do indeed expire. Whereas I think in practice, no matter who is elected in November, they will seek to roll over at least some of those tax cuts. So actually, that CBO estimate, like I say, could be an underestimate of the true extent of the size of the deficit over the coming years. Now, set against that, if you look a bit further ahead, it's possible that actually the US economy might perform a bit better than the CBO is intending. We've talked before, haven't we, about how the AI revolution is likely to feed into a pickup in productivity growth, particularly in the US. The US particularly well positioned to capitalize on the AI revolution. So that would help to improve the fiscal picture in the same way that the ICT revolution helped the Clinton administration improve the fiscal picture in the 1990s because productivity growth was picking up. So long-term fiscal forecasts, I think the point I'm making here is they're incredibly difficult to make because they're subject to different changes in policy. And we know that particularly the expiration of these tax cuts in 2025, that's going to be a big determinant. And then potential changes in long-run growth as well and exogenous shocks that might affect that. If you take a step back, the US fiscal position, though, is pretty dire. Deficit 7% of GDP, debtor's share of national income, multi-decade highs. For the markets, the focus, I think, is less on the CBO and its projection, but on the Treasury's so-called QRA releases, the quarterly refunding announcements, which the next one of which is due in July. This is the amount of money that the Treasury thinks it's going to need to raise to cover deficits, but also to cover maturing debt. So the markets perhaps won't focus quite so much on the CBO projections. The issues and challenges are pretty well known. The projections themselves are important, but aren't necessarily going to move markets. The QRA, as I say, the next of which is due in July, I think is going to be potentially a bigger market moving event.
So supply demand in focus in the bond market, but let's pan out a bit more. Our proprietary measure of China's new 3 industries was refreshed this past week. It's showing a massive rise in exports of batteries, solar panels, and electric vehicles to other emerging economies. The battery, solar, and EVs, these are what the government considers the new 3 industries. On the one hand, you could argue that all of these exports imply much lower costs for the green transition for these economies, and that's been Beijing's argument to some extent. But isn't another view that China's imbalances are as much a problem for emerging markets as they are for advanced economies?
Yes, and I think India is interesting in this regard. So there's been a lot of focus, we have a lot of client questions too, on the extent to which India might capitalize on some of the opportunities presented by US-China fracturing. So to the extent that production is moved out of China because of national security concerns, supply chain security concerns. Some of it's gone to India. Apple's set up in India. It has this ambition to manufacture a quarter of the world's iPhones in India by the end of this decade. So India potentially a beneficiary from some of the disruption caused by US-China fracturing. But that's all in high-tech goods that have implications and consequences, for example, for national security, supply chain security. If you look at in other areas, in kind of more mundane, run-of-the-mill consumer goods, toys, furniture, clothing, India's market share, global market share, has been at best flat and in some cases falling. And when you dig into the detail, it seems that India can still lose a market share to China. And that's evident too in the fact that India's bilateral trade deficit with China has exploded over the past couple of years. So it's true that India stands to benefit in some respects from US-China fracturing, but the bigger picture is that that's only affecting a relatively small amount of global trade. And in the vast bulk of global trade, China is still vastly more competitive than India, and it's starting to squeeze India's position. Now, all of this matters because we know that developing a competitive manufacturing sector is critical to long-term economic growth if you're an emerging market, and India's government's aware of this too. So India's manufacturing sector is about 13% of GDP. That's kind of the same share that the US has and the UK has, rather than in China, where it's much closer to, say, 30% of GDP. So in a very real sense, the fact that China is extremely competitive in some of these industries means that it is squeezing India and it is making it harder for India to establish this manufacturing sector. Now, interestingly, that's also having an effect on India-China relations. So we have seen over the past year, for example, India's taken steps to reimpose a de facto ban on imports of solar panels from China. So it's not just the US and the EU taking action against China. We focus on the tariffs and and so on that Washington and Brussels have imposed on China over the past month. But India's also taken steps in this regard. So another sign that the world is pushing back against excess capacity in China.
Neil Shearing on Chinese manufacturing overcapacity and the threat to emerging economies, including India. Our proprietary trackers of the new 3 industries are refreshed each month. They're available as an interactive dashboard on CE Advance with downloadable data. Find out more about Advance at capitaleconomics.com/advance. On elections, we're holding drop-ins. These are our short-form online briefings the morning after the UK election on July 5th and after the second round of voting in France on July the 8th. Sign up for those for more on the fiscal outlook in both countries, and I'll add relevant analysis to the notes of this episode for you to take a look at, including analysis of the UK's fiscal rules that Neil was talking about. Now, shares in chipmaker Nvidia had a brutal end of last week, falling 9% over Thursday and Friday and slashing their year-to-date gains to a mere 160%. Yep, this is the poster child for an AI investment arms race, and it's been the most notable member of the Magnificent Seven, that group of big tech firms that have done so much to boost the S&P 500 in the last few years. In fact, our end 2024 target for the S&P of 5,500 was hit early on Thursday, 6 months ahead of schedule. When our markets team published that target a year ago, it was seen as far too bullish. Our team's response was that the consensus just didn't get the full implications of what AI would do to economies and to stock market valuations. So here we are at our end year target. What comes next? Will AI enthusiasm keep pushing valuations ever higher, or is this generation's tech bubble and it's one that's on the brink of bursting? To find out, I spoke to Jonas Goltermann, our Deputy Chief Markets Economist, ahead of the Friday Open, and I started by asking him to explain what's been driving the market of late.
Well, over recent weeks, it has been increasingly all AI all the time. And most of all, as you say, NVIDIA, which is the poster child of this AI narrative, AI bubble, if you will. Since that company's last earnings report about a month ago, NVIDIA has gained about $1 trillion, that's a trillion, not a billion, of market cap, or just about 40% in price terms. NVIDIA alone accounts for about 2/3 of the gains in the S&P 500 index over that period. If you go back to the start of April, NVIDIA accounts for about 1/2 of the stock market gains. Other tech firms make up the rest. In fact, more than make up the rest. The non-tech parts of the stock market has actually stalled out since the start of April. And indeed, looking outside of the US, most other stock markets, which are generally a lot less tech-focused in terms of their composition, they've also faltered a bit.
We're getting echoes, aren't we, of the dot-com bubble here? I mean, how sustainable is it that you have a rally that is so reliant on just one stock to deliver returns?
So the dot-com bubble has always been the kind of obvious analogy for what's going on right now over the past year or so. And we've certainly spent a lot of time looking back at that period to inform our views about what is going on currently. And there are many commonalities, most obviously that it's centered around a new, potentially transformative technology. In a sense, AI is maybe the extension of the IT revolution. And indeed, many of the biggest bubbles in history, if you go further back as well, they're also built around new technologies. The railway bubbles in the 1800s are a good example. And to some extent, the 1920s bubble in the US, maybe to a lesser extent, but it did incorporate similar things from what we're seeing now, enthusiasm around new technologies. Back then, it was things like cars or radios or the first consumer electrical appliances, which was seen as sort of transformative. And obviously they have changed the world enormously, just not to the extent that maybe was built into the stock market at the time. The extent to which the recent rally, especially over the past, say, 2-3 months, is so overwhelmingly about a single company is, I think, unusual. It does mean that we are really reliant on news about this one firm to a degree that's maybe a bit worrying. And you've seen days like Thursday when NVIDIA drops back. It does tend to drag the rest of the stock market down as well. Now, my sense is that for the overall stock market rally to continue over the coming quarters, as we expect it to, we will need to see a bit more diversity in terms of where the gains are coming from, both in terms of other tech firms doing better, but probably also in terms of the wider market getting a bit more of a valuation boost, sort of a rising tide lifts all boats effect, which to some extent was a feature of the late 1990s. Now we're in the process of firming up a new set of forecasts for equity markets, but certainly our base case will remain optimistic, especially for the US. I think barring some unexpected shock, like a recession or something really serious on the, say, political or geopolitical risk front, we think the rally has further to run. For example, one proxy for the equity risk premium is if you subtract the yield on a long-term inflation-protected treasury bonds from the equity market's earnings yield. Now, that measure has fallen sharply over recent months, but it's still around 2%. Back in 1999, it was negative. So if that's the right analogy, then there is more to come before we get into sort of truly unsustainable territory.
The thing about bubbles, though, is that they burst, don't they? As you suggested, a lot of this seems to be hinging on investor faith in the potential of AI. But what happens if we get signals that this AI investment arms race is fading?
Well, I think anything that's based on faith, or maybe call it sentiment, maybe somewhat less charged term, there is an inherent fragility in that it's going to be less predictable than trends that are rooted in cold hard facts and more slow moving, stable fundamentals. I mean, the human psychology, it's fickle, and so this rally, it's one that is maybe more likely than others to go into reverse simply at just a flick of a switch for no obvious reason. That is a feature of past bubbles bursting, where they come to an end very suddenly, often without a clear catalyst, at least not something that is obvious at the time. And that's precisely because, especially at the later stages of a bubble, it becomes so reliant on sentiment staying positive. In terms of faith in the prospects for AI technology, well, I think to simplify a bit, the big stock market gains so far, especially over the past 2-3 months, they've been made by companies that are involved in the supply chain for making the chips required for the data centers that you need to run AI models off. First and foremost, NVIDIA, but also firms like ASML, which makes the machines that makes computer chips, and TSMC, which is the world's largest chip manufacturer, and a range of other sort of smaller firms involved in one way or another in semiconductor industry. So in other words, it's the firms benefiting from the investment in AI technology that are driving the gains in the stock market. And for them to make, the large earning gains, it's not just expectations about future gains, it's you're seeing it in their actual earnings as well. AI technology doesn't actually have to work. They just need other companies to be buying their chips and other services and so on to invest in AI in the expectation that over time the technology will deliver big gains in productivity and new consumer products. One sort of famous saying that I like to go back to is this idea that the surest way to make money in a gold rush isn't to dig for gold, it is to sell shovels. That way you make money whether there is any gold or not, and irrespective of who is finding it. Putting it crudely, NVIDIA and the other firms that are doing best now, they're in the business of selling AI shovels, which is why they're doing so well. I think at some point, for the rally to continue, the bubble to go on into next year, you're probably going to have to see some kind of evidence that downstream of this, more for a wider set of firms and the economy more broadly, is actually reaping the benefits from all this investment in AI.
Jonas Goltermann there speaking about the US stock market bubble and the shovel sellers in this era's gold rush. Shortly after we spoke, the team published their revised S&P 500 forecast. They're now looking at 6,000 at the end of this year, so around 9% above current levels. I'll put their note about this in the podcast note so you can see the full justification and our new end 2025 forecasts. Finally, back to India. It wasn't surprising that Narendra Modi won this recent election. It was surprising that his BJP lost its parliamentary majority. Given how much and for how long it's dominated Indian politics, it was also unsurprising that markets initially reacted so negatively to the news. But the dust has settled, markets have recovered, and Modi's third term has begun. So what does coalition government mean for the Indian economy? Our India team has just published its latest quarterly economic outlook, and I spoke to chief author Shilan Shah about the report, starting with what the election result means for near-term growth.
I think the key point really is that although Modi is going to start his third term with a weakened mandate, he is overseeing an economy that is primed to grow by probably around 6.5% to 7% a year over the next couple of years, which by global standards is, of course, extremely strong. And in fact, those rates of growth leave India on course to overtake both Japan and Germany to become the world's third largest economy as soon as 2026 or 2027. So the near-term picture is still pretty positive. I think the one key risk really from the election result is that it could lead to a slight loosening in the fiscal stance. Under the BJP, the finance ministry has run a pretty tight fiscal ship, which has been focused on consolidating fiscal policy whilst also re-gearing spending towards more longer-term infrastructure projects. There is a chance now when we get the budget in July that the BJP has to make concessions to some of its coalition partners, particularly by boosting spending in some of the states where those coalition partners have very strong support. But it is worth noting that the coalition was formed very quickly after the election result. The BJP is also working with parties that it has had a functioning relationship with for much of the past 10 years as part of the wider National Democratic Alliance. The key point being is that this is a stable coalition, and so that probably limits the need for very big fiscal concessions.
You mentioned there Modi's weakened mandate. You're talking about India's move to coalition government. Look a bit further out there beyond the near term. What does this new political arrangement in India mean in terms of these longer term questions around reform?
Well, this is the big talking point, really. I mean, I think the whipsawing in both the market reaction and also the wider commentary has been really fascinating. And I think probably speaks volumes about the confusion over what this means for long-term growth prospects. Initially, markets sold off. The commentary was all about how this would hold back the economy. But more recently, markets have recovered. There's been some revisionism in the wider media with people now talking about that actually checks and balances on Prime Minister Modi's power is a good thing and that reforms won't necessarily be impeded. Now, for our part, we've maintained a pretty optimistic view of India's longer-term prospects, and the election result doesn't really change that. I think it's true that some contentious reforms, particularly on the labour market, may now become harder. But it's also important to acknowledge that Prime Minister Modi is heading up a stable coalition, and there is also a broader embrace of the value of economic reform from across the political spectrum in India in a way that probably wasn't there, say, 10 years ago. So these are all encouraging reasons, I think, to think that progress on boosting both physical and digital infrastructure, for example, will continue, and that the new government will continue to embrace foreign direct investment as well.
There's quite a cosy consensus, isn't there, about India's long-term growth potential. It's got to be one of the more upbeat long-term growth stories in the global economy, but is it too cosy? I'd like to revisit your April report, which you titled What Could Go Wrong. Talks about the various risks facing the long-term India outlook post-election. Talk about some of those risks that you outlined in the report, and talk about whether your thinking has shifted at all on this.
Yes, I think that's right. Now that the dust has sort of settled on the election, there does seem to be this emerging consensus that actually the long-term prospects for India are upbeat. And clearly, for the most part, it's a view that we share. But I think it's important for investors to be clear-eyed and be aware of some of the risks to that, what is an otherwise pretty positive outlook. I think really the big challenge for the new government is to be able to create high-quality jobs that can absorb the labour force. Some of the reforms that we've discussed can help to achieve that because they help to strengthen the domestic manufacturing sector. But in some ways, overarching all of this really is China's manufacturing dominance, which India can't really compete with on a global scale, particularly at the lower, more labour-intensive end of the manufacturing spectrum. So in areas such as textiles, furniture, and toys, for example. So there is a risk that the government isn't able to create enough new jobs, and then therefore the electorate speaks up even more sort of vociferously in the future. Beyond that, I think another risk that we should be keeping an eye on more for the next sort of 3 to 5 years is the emergence of generative AI. Now, this is something that we've done lots of work on. India feels quite unique because it has very successful outsourcing-led model of growth, but lots of the jobs that generative AI is able to replicate are those ones within that sector. And so there is a concern that it leads to the displacement of that, or disruption in that sector. And that could lead to a hampering of growth prospects over the next sort of 3 to 5 years as well. Now, this isn't a risk that we think is going to completely crater the economy. We think that with the help of upskilling and reskilling and redeployment of capital, that actually India could navigate that risk pretty well. But it does mean that the government needs to get lots of things right.
That was Deputy Chief EM Economist Shilan Shah on India's near-term economic outlook and why its long-term prospects aren't without risk, even if the consensus suggests otherwise. I'll add the Outlook report to the podcast page, but also that What Could Go Wrong report. We also have an interactive dashboard covering India's economy. It's the 25 charts that clients most request with access to underlying data. It's an essential tool for analysis, for presenting to stakeholders, for reporting requirements, etc. Again, available with CE Advanced, details at capitaleconomics.com/advance. But that's it for this week. We will be back next week with a UK election preview and much more from the front lines of global macro and markets. Until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.